This is a podcast from the Business Times.
Good evening. It's Wednesday, July 29th, 2026. Here's your market-focused daily closing bell update by the Business Times. Asian technology shares extended their sell-off today, with semiconductor names leading the decline as investors questioned lofty AI valuations and whether the capital expenditure being poured into the sector will generate sustainable returns. Asian markets also took their cue from another steep decline in U.S. chip stocks overnight. MSCI's broadest index of Asia-Pacific shares outside Japan fell more than 2.4%, extending yesterday's sharp losses. South Korea bore the brunt of the declines today as the Kospi plunged more than 8% today, triggering a trading halt for the second straight session. It closed 5.98% lower at 5,663. Memory giant SK Hynix tumbled over 10% after missing analysts' estimates, despite reporting record quarterly earnings, while Samsung Electronics fell 5.23% at the close today. Meanwhile, South Korea's finance minister apologized today after rule changes introduced earlier this year that fueled a speculative trading boom, has left retail investors nursing heavy losses from leveraged stock investments. Japan's technology sector was similarly weak, as its computer memory maker Kioxia dropped 10%. SoftBank Group also slid 6.95% today, as investors reduced exposure to AI-related names. The Nikkei benchmark index eased by 1.49% closing at 61,434. Taiwan's benchmark index also retreated, the TAIEX falling 3.76%. TSMC, the world's largest contract chipmaker, slid 3.51%. Greater China was the bright spot in an otherwise weak regional session. The Hang Seng Index rose 1.92%, although gains were tempered by a 2.53% decline in the Hang Seng China Semiconductor Index. Meanwhile, mainland China's CSI 300 added 0.67%, closing at 4,600. Markets are now looking ahead to more key developments out of the U.S. this week, such as big tech earnings and the Federal Reserve's policy decision. Earnings from Microsoft, Meta, and Apple this week are expected to provide another key test of the AI investment story after disappointing cash flow and earnings reports from Alphabet and Tesla rattled investor confidence last week. U.S. stock futures pointed to a positive open today, with all three major indexes, the S&P 500, NASDAQ 100, and Dow Jones Industrial Average, trading higher. Commodities were also in the spotlight today, as oil prices rose after renewed attacks in the Middle East shattered the relative calm seen in recent days between the U.S. and Iran, reigniting concerns over potential supply disruptions and their impact on inflation and global interest rates. Brent crude futures climbed more than 3% to $87.19 a barrel, while U.S. West Texas Intermediate crude rose over 3% to $82.08 after U.S. Central Command said Iran had launched missile strikes targeting U.S. bases in the Gulf, all of which were successfully intercepted. Separately, U.S. and Saudi forces carried out strikes on multiple logistics and weapons sites in eastern Iraq, saying the operation was in response to more than 30 drone attacks over the past 3 days by Iran-aligned militant groups. Turning our attention back to equities, European stocks opened higher today, supported by gains in mining and energy stocks. The pan-European STOXX 600 rose 0.35% to 648.54, while the German DAX and the London FTSE all opened up higher in early trading. With the European earnings season in full swing, investors are balancing corporate results against an increasingly uncertain geopolitical and macroeconomic backdrop. That's it for today. For more business news and market updates, visit bt.sg and Lens on Daily for the latest tomorrow at 10 a.m.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.